I'll be able to provide benefit to those attending and help explain better a very crucial and important part of the startup journey. I'll keep the self-promotion towards the end. I'll talk a bit about AB Ventures at the end, but it is like you described it. It is the VC arm of Arab Bank. And the particular reason is I chose, to talk about cap tables, is that it is one of the parts of the venture industry where it's less about the art and it really is more about the science and the math. So this is one area of a startup journey that can really be understood and learned in a let's say in a fundamentals-based manner. So without further ado, I'll start with my first slide. Most of you know what cap table stands for. Cap is basically short for capitalization. It's a breakdown of the company's ownership. It is typically found in the balance sheet of a company, and it represents what is referred to as a line item, shareholders' equity. The cap table can include obviously equity. It can include other types of securities. In the case of startups, it is usually equity and convertible debt. Although not securities, it can also include in the cap table any issuances, prior issuances, cancellations, transfers, or sales of equity or convertible debt, if that had taken place. There is no standard template or one way of displaying a cap table. So I can't say there is a wrong or right way to display it. It's essentially what is preferred both for the founders and the investors. And it really is meant to be case specific and context relevant. So you can add a lot of details. You can make it quite summarized. It really depends on what you are using it for. My preference is to basically put in either in full view format or at least in appendix format as much as information as possible, because that really saves a lot of back and forth between typically incoming investors, existing investors, and between the founders and the shareholders themselves. So why are cap tables important? As we will show in a brief example, they essentially illustrate in chronological order all of the investments that were made in the company over time. They show who came in first, who came in last, how much money they put into the company, what was the price per share that they paid at each funding round. And in case of multiple rounds, you can calculate the average price per share of your shareholding. And it basically displays, like we said, the current ownership of the company. In cases of convertible debt, it can also show you on a fully diluted or future basis, on an as converted basis, what that ownership would look like once that convertible debt, warrants, stock options are executed. So it visualizes all of that. And in the case of people like us as investors, this is important because for certain funds, you need to file either quarterly or annual reports, and having organized cap tables for your portfolio company really, helps you and makes it a much more efficient manner. For the startup itself, and I can talk about this extensively, for even more than an hour. I'll talk a bit about why it is important. I'm sure all of you know this as founders. When you're first starting a company, and this really extends beyond the very initial stage, but one of the most important resources for you as a startup is the liquidity. It's the cash. So typically, founders and companies are quite conservative in the way they spend their cash. They are far less conservative in the way they handle their equity. So if for a startup, when the equity is, let's say, ample, or the equity is available, founders and startups tend to be, free-handed in the way they dish out equity. They put less value or assign less value to it, and they essentially look at it differently than the way they should. I'm going to mute myself for
So I am here and Faisal is back.
That small family dispute between the kids. As you can notice, I'm not in an office environment, I'm at home. So I was talking about, the way people hire, the way people use their cap tables at the beginning. They basically, which is not the wrong thing to do, is they assign a lot of value to the liquidity or the cash in the company, and in certain cases they assign less value to the equity, because at that point, what is really of value is the cash and the cash reserve in the company, and protecting that is of paramount importance. So a cap table, in that sense, is a very effective tool for yourselves when you want to hire key employees, and it also is an important tool when you want to finance the company. So that's the starting point for looking at valuations, and also it's a very important negotiating starting point for incoming investors on matters like protective provisions and reserve matters. And those related with the control of the company itself. Plus, having clean cap tables is always a reassuring thing for investors. It shows that you, as a founder, have a good understanding and a good comprehension of what your balance sheet looks like from an equity standpoint. And it also makes our life much easier when conducting our valuation exercises, when doing due diligence. So it's always a good thing to have a clean, and I'll talk about what we mean by clean, but more importantly, an up-to-date cap table. What goes into a cap table, and I'll show you in the example. I mean, you can start with a spreadsheet. There's nothing wrong with that before, using more elaborate tools. A spreadsheet, Excel sheet is more than enough. It essentially has a listing of, typically in chronological order, of the people who are shareholders in the company, how many shares they hold, how much cash did they invest, what are the types of shares that they hold, and also in addition to that, for the company itself, what is the authorized shares, how many of those authorized shares have actually been issued or outstanding, the delta of that, what are the unissued shares, and then if you have an ESOP or an employee stock option plan, what part of these shares have been vested, allocated, and what part of it have not been allocated or vested yet. So that visualization of the detail is quite important. Now, bear in mind, also for investors, while we do assign value to having that clean and updated cap table, when we do a legal and financial due diligence on a company, we also look at the supporting documents for that cap table. So for us, while a cap table is important, it also has to reconcile with the subscription agreements, with the convertible notes, with the warrants, with the stock option documents. So the real truth behind the cap table isn't really in the Excel sheet, it's in the signed official documents. This is an example of a startup. Burak, I used your name, and I assumed your co-founder's name is Mehmet. So this is a very young company where you guys have both invested $5,000 each. You've issued 10,000 shares. Each share is worth $1, and you both own 50% of the company's cap table. So both of you have 50% of the issued shares, and all of your shares are obviously common shares.
This may be a new company, not the old one, but a new company.
Absolutely. An old company. Yeah, a new company, sorry. Now, you guys have been quite successful. You've been busy. You've built a prototype. You've built an MVP. You've yet to go to market, but you've attracted a lot of interest from angels, and you actually managed to raise 3 separate angel rounds. The first one was a $1 million credit convertible note at a $10 million cap, non-interest bearing with no discount. The second was a bridge round of 600,000. It had no cap, but had a discount. And then the final round prior to your Series A was $2 million. It had a $15 million cap and also had a discount at the same time. So the reason I've made these is, to see what the impact of those angel rounds when they're convertible notes on your cap table, because it's a slightly more different calculation than from a straight equity round. Now, the company then was successful in launching the product. They talked to Series A investors, and they managed to raise a 5 million Series A round at a $20 million pre-money. This is what your cap table would look like. After that, all of that money comes into the cap table, and after all of these angel rounds are converted. Now, bear in mind, most convertible debt is convertible either at an expiry date to the option of the issuer of the convertible debt, or the occurrence of a qualified financing round. We are assuming that the Series A is a qualified financing round, and all of these convertible notes were part of that round. So again, you look at the cap table, Burak and Mehmet have the same 5,000 shares that they started with. The company now has a total of 15,208 shares. How did we arrive at that number? If you look at the angel round, the angel one investor, their pre-money cap was at 10 million. The company raised at 20, so they converted at a 10 million. So these guys got a heavy discount. You divide 10 million by the number of shares prior to the round, which is 10,000. You arrive at, if you can see my cursor, the $1,000 per share price over here. They got seed preferred shares. The Angel 2 guys had no cap, but a 20% discount. So they converted at a pre-money of 16 million. So they paid 1,600. And then the last guys had a cap of 15 million and a discount of 20. The way these usually work is that you get the lesser of. So applying a 20% discount on a 20 million pre-money is 1,600. Whereas applying the cap of 15, you arrive at 1,500. They get the lower of that, so they convert at 1,500. Each of them get their respective shares as shown on the list here. And then the Series A guys come in with $5 million at a pre-money of 20 million, so $2,000 per share, and they get 2,500 shares for their investment. You can see the ownership percentages here. Burak and Mehmet still retain quite a hefty part of the company, almost 66%, which is a beautiful shareholding at a Series A level. And then the rest are as per shown here. Now, the one very common question that people ask is, if this company raised 5 million at a pre-money of 20 million, shouldn't their post-money be 25 million? Actually, in this case, their post-money is a bit more than, actually significantly more than 25 million because of that convertible debt. And the easiest way to calculate it is you take the last price per share that was paid by the Series A investors, the $2,000, and you multiply it by 15,208 shares, you arrive at a post-money of 30 million plus. So in this case, the post-money was higher because of the convertible debt and the different treatment of the convertible debt. Now, this type of cap table, I mean, this is a summary cap table. It's just not a detailed cap table, but it shows you at least, you know, the fundamental aspects of what we as investors and what you as founders should have on that cap table. And it's, like I said, it's very factual. Ideally, you'd want to have the supporting documents for the founders, the angel investors, and the Series A investors that, you know, basically reconcile with what is shown on the sheet that I just showed you. So clean versus messy cap tables. I think the most important, point here or tip is that it is always infinitely easier to keep a cap table clean than to attempt to fix a messy cap table. So once you have a messy cap table, it really becomes painful. Fixing it is not easy. And the options that you have available are, you know, they're all difficult options. So my advice is don't get to a messy cap table. And here I'm not talking messy in terms of, you know, preparation and presentation. I'm talking in terms of constitution. So keep your cap table as clean as possible. And then I'll explain what a clean cap table means. Because fixing a messy one is never an easy task for founders or investors. So what is a clean cap table? A clean cap table typically has 3 types of shareholders on it. It has founders and key management. on it. And so founders is pool number one, key management or key employees is pool number two, and they can be interchangeable. Sometimes your CEO, CTO, COO are also founders. And then the last pool are the investors, the people who put money into it. Anyone else on the cap table is really dead equity. This is equity that you would want to avoid having on your cap table in the first place. And I'll give examples of, the typical pitfalls of dead equity. So it's better to avoid that from the beginning than to get them on and then try to fix it later on. So founders ownership, like, in the prior example that I gave, Burak and Mehmet, after their Series A, they own around 66% of the company. That's a beautiful cap table for a Series A investment, because what that means is they've managed to retain majority ownership after their first big institutional round. And this is important. Why is this important? Because this basically means that Burak and Mehmet now own 66% of a company that is worth $30 million plus. If Burak or Mehmet get depressed, if they hit a bump in the road, if they get an offer from someone else, it will be very, very difficult for them to leave the company. And that essentially is what your investors want. They want for the founders to have skin in the game. They want them to be economically compensated or vested. Let's not say compensated. They want them to be economically vested in the business in a way, come hell or high water, these people will not leave the company and they will stick it out in good or bad. And that really is why you want a big chunk of the company, especially at the early stages, to be held by the founders. And that, I can tell you by experience, is something that an educated investor would also want. Because as I explained, if you as a founder are not vested, or as founders are not vested in the business, and the business does not perform well, you start looking elsewhere, you become disengaged, you become disinterested. And because you've only put $10,000 against the 8.6 billion that was put by the other investors, you really have very little incentive to remain in a company where you don't own the majority of that business. Now, a very common example of dead equity, we all know the friends, family, and fools dilemma. So that really is one area of dead equity. So I would advise you, although it's very appealing to take money from FF and F, keep that at minimal and keep it as convertible notes and keep mindful of the fact that when these people convert, they should be at the very low end of single-digit shareholding. So ideally, you want them to be in the below the 5% bracket, usually below the 5% bracket, and ideally in the 1 to 2% bracket, if possible. Another example are vendors. If you're building a startup and you're buying a solution or you're outsourcing part of your technology to a third party, it's very appealing to pay these people in equity, not in cash, for the same reason I explained. Don't do that. If you can't hire a CTO and have them come in and pay them as co-founders in equity through an ESOP or through a vesting schedule to them, I'd really advise you against giving out equity to vendors. Now, if you end up in a position where you are really in a messy cap table, where you have a lot of people who fall under the dead equity component, you will have to have that conversation with your dead equity holders. And it's something that you as a founder who is vested in the company and incoming investors who are interested to put money but are basically put off by the messy cap table, that conversation is a three-party conversation whereby you have to convince them that them owning 20% of a company that might go bankrupt is far less appealing than them owning 2% of a company that might be successful. And the way you can do that, because these people have given you money, how do you take them from 20% down to 2%? It is essentially an equity earnout to you as founders that is performance-based. So whenever you hit a milestone that is related to operational or product or financial results, you guys get a transfer of their shares back to you as founders. which, as investors is something we would want to see. Like I said, we want the founders to maintain ownership of that businesses. And then as a last resort, one way to do it, if you really arrive at a gridlock, is you scrap old company, and it's something I advise against, and you transfer all of your know-how and knowledge into a new company, and you put the new incoming investors into that company. But that really is a very last resort, and I would advise against it, because if you have, sharp-elbowed investors, they will take you to court if you attempt to do that. So that really should be a last resort solution. What are the very common mistakes of cap tables? The first one basically correlates to what I said earlier about keeping a clean cap table. If you basically raise too much money, you will have to award too much equity against it. So you bite off more than you can chew, you overcapitalize. How do you avoid overcapitalizing? You build out or you build a very thorough business plan. You test it, you stress test it, you get people to challenge you on it. You run basically tests on it. And if it pans out, you reverse engineer your financing needs based on that business plan. So if the first version of the business plan tells you that you need $1 million to arrive at an MVP, okay, don't take that $1 million and go to the market and try to attempt to raise $1 million. Do something else, revise that, try to drop the number, whereby, for example, instead of raising $1 million, let's say you raise 800,000. It might not seem like much, but a 20% decrease in the amount raised will pay off tremendously when this company becomes a larger business. So do that, raise just enough capital. At the same time, don't undercapitalize your businesses. So the important part of that is the initial part that I mentioned, is to really have a very robust and well thought and well planned, well-tested business plan that can tell you how much money do you need. And think of your cap table to mirror those investment rounds. So in the example that I gave, Burak and Mehmet own 66% after their Series A, assuming the industry that they're in and the business that they're building will take, let's say, 5 private funding rounds before it becomes a trade sale acquisition. So that means that after the 5 million, they probably need to raise another 50 or 60 million spread over 4 different rounds. They keep ramping up the valuations and the amounts raised round after round. So what would be, Burak and Mehmet now own 66% of a company that is worth 30 million. So around 20 million of a company that is still highly risky and at an early stage. What would you say is an adequate ownership percentage of a company that might sell for 250 million? I would say 10% of 250 million that is de-risked and with a high potential to actually sell is a very nice number. So they're now at 66% at the Series A. If they arrive at 10% by the time they exit, that's a beautiful transition from a Series A to an exit. So you have to reverse engineer your funding rounds in a manner that you account for the dilution at every different stage to drop from, they started at 50% or 100% to take it all the way down to 10%. So that's an important part of how do you think about not over capitalizing your business. The other common mistake is that at the beginning you do handshakes and gentleman agreements. You take money from friends and family, and you don't write any documentation that attests to the money that was put into those businesses. That is also a very big mistake. Don't do that. Just a minute. Yeah, my battery is about to go, so I'm just making sure my.
No problem.
Sorry about that, Burak.
No problem at all. By the way, let me, if our founders have any questions, please ask question and answer session. I have many. Some of the terms are very important. Ozan is also here, so he will probably be jumping after jumping on the board after the presentation is completed. I am here and waiting and excited to listen all those slides. By the way, Faisal, go ahead, please.
Sorry about that. So yeah, we were at the slide. So never take money from friends and family, even if they're your sisters, brothers, parents, without writing something down. That is important for us as incoming investors. Write everything down, have it proper, have it filed. I mean, you'll be very thankful that you did that later on. If these terms, I mean, especially for angel rounds, are written, make sure that they're clear in terms of being modeled on an Excel sheet, like I just described, because sometimes the language doesn't travel very well from a text to an Excel sheet. So it's proper that you have both. You have them written down on the documents that were signed, but you also have a model annexed or attached to it, whereby there is no confusion on the numbers. Usually, when you talk to investors, they would want to know, apart from the stock certificates themselves, the total number of shares outstanding, and that also includes the point behind it, which is the convertibles. So usually investors look at cap tables on a fully diluted basis. What does the cap, or what would the cap table look like, and hence what would their shareholding look like if all of these outstanding convertible debt is converted, or if all of the stock options are awarded to the employees, because typically these eat into the investor's shareholding. Also, a common mistake is you usually have same investors coming in through different vehicles. So, I mean, keep the names separate, don't aggregate shareholdings, and keep the names consistent. The other very common mistake is something that I alluded to earlier, which is the handing out of equity. If, as an example, you decided not to give your vendor equity against the work that they offer you, which is a good thing to do, and instead you opt to hire a CTO, don't give that CTO their 10% or 15% from the get-go. Have a vesting schedule that basically corresponds to their deliverables and the time that they serve as a CTO in your company, so that they build up towards that incentive. And in the hopefully unlikely case that they leave the company, you're not in a position where you have someone who owns 10-15% of the cap table and doesn't work at the company anymore. ESOPs, in my opinion, should always be post-money, not pre-money. A pre-money ESOP is investor-friendly. A post-money ESOP is founder-friendly. And the reason I say that is because if it's a post-money ESOP, that means I, as an incoming investor, also get diluted when you assign that employee stock option plan, as opposed to a pre-money ESOP where I get to dilute the ESOP when I enter. So always do them post-money, not pre-money. And then there is the tax implications. I'm not sure how applicable that is for the majority of the startups that are in tax havens. But for some companies that are in taxable jurisdictions, this really does become a pain point, because employee stock options are taxable. And if they're awarded at a later stage, when they're worth a lot of money, you might wipe out any economic or cash-based incentive that that employee has. So the way to avoid that is, build the vesting schedules, but don't build them too far into the future. In my opinion, most vesting schedules should happen between 18 to 24 months. And then the last common mistake is the debt equity part that I talked about. Avoid that at all costs. It really becomes problematic. And this is basically what a messy cap table looks like. Having too much debt equity is really a pain, and it's difficult to solve once it's there. I think that ends my talk about cap tables. I mean, I cannot emphasize how important these are in ensuring that your company is successful, investable, continues to raise funds, and has the right people alongside you as you build your startup. And like I said, I mean, unlike most other aspects of building a venture-backed business, there really isn't a lot of fluff and magic around cap tables. They're very straightforward, they're mathematical, they're Excel sheet or spreadsheet based, and you just have to be wary of how do you build that cap table and how do you take it from one stage to another. Now, one last parting point on cap tables before I do this shameless self-promotion on AB Ventures is that not all businesses are venture backable or venture investable, and not all non-venture investable businesses are bad businesses by nature. And for me, the key differentiator between something that is venture investable and something that is not venture investable, I mean, people might differ with me, but the key differentiator for me is their ability to scale. So usually venture-backed businesses are businesses that can scale fast and, you know, beyond what you typically see in a conventional business, as opposed to ones that are much slower to scale and eventually have a glass ceiling to how much they can grow. If you're of the latter type, if you're building a more conventional business, I don't want to say all what I said, but most of what I said might not necessarily apply. Debt equity on a non-venture backed business is not a terrible thing if they've provided good financing at a certain point of the company's growth phase. And usually you don't need multiple rounds to build a more stable non-venture investable business or conventional business. You don't need to go through series, seed, pre-A, post-A, B, C, D, E, F, G. You don't need to do all of that. Usually, if you have a good head on your shoulders, it might be one or two funding rounds and you hit cash flow positive and that's it. So I'll end with that. Very, very quickly, I'll talk about AB Ventures. It is like Burak presented us. We are the corporate venture capital fund of Arab Bank. If you don't know Arab Bank is the largest and oldest bank in Jordan. It is also the largest banking network of any MENA-based bank. We are present in 26 different countries. It's not something to be particularly proud of, in 2020, but we do have around 600 branches in those 26 countries. So we have the biggest banking network among all of the banks that are based in MENA, and that really is one of the strength points of us as the venture capital arm of Arab banks. Corporate VCs, as some of you might be aware, are not the first preference for some startups, especially in touchy-feely areas like financial services. So good startups would tend to avoid working with a corporate VC early on. I don't want to say that isn't the case for AB Ventures, but it's slightly different because of that presence. We can offer access to markets, we can offer infrastructure, we know how to navigate intricate regulatory environments, and we've been doing this for 9 years. So, I mean, as a partner, Arab Bank is definitely one of the better partners to have in the financial services industry in the Middle East. We invest early stage in financial technology, obviously. Our definition of financial technology is quite wide. It goes beyond the conventional verticals of payments and lending and includes things like machine learning, data analytics, artificial intelligence, blockchain applications that might have not necessarily been built for a financial industry application, but ones that a bank can directly or indirectly benefit from. We usually pool our investments or target companies into two main categories. Companies can either be tactical or strategic. Tactical meaning that they have a product or an offering that addresses one of our existing pain points as a bank, something that we can use immediately. Or strategic, they basically offer an answer to a question that we might have not asked ourselves, but one that we believe might be of value in the future. So that's basically how we look at it. We understand in maybe 10 years or less, the entire banking industry will look very different. most financial services will be offered through platforms. Those platforms might not necessarily be operated by banks. They might be operated by super apps that use us as a backbone, or preferably we have the customer custody, we own the relationship, we are the platform with the clients, and then we have other parties plug into our platform to offer other services. We invest between half up to $3 million US. Usually we do an initial investment and then double down to arrive at that 3 million cap. We are early stage investors, so anything between seed up to Series A. We might go beyond the Series A depending on the geography and the market. Financial products, services, and tech companies are slightly overpriced in most markets. We are not bound by geography, like I said, and in the worst case scenario, we might end up owning 25% of the companies that we invest in. Very quickly, these are the 8 companies that we have in our portfolio. I won't bore you with them. You can go onto our website, which is on the first slide, abventures.vc. You can read more about those companies and go to the websites. But basically, we currently have, like I said, 8 companies that are split almost equally between mainland Europe, the UK, and the US. We have a very aggressive mandate to invest in the Middle East, including Turkey, for next year. So we're on the hunt for good deals. If you are a founder of a financial technology business that you think is worthwhile to have a conversation with AB Ventures, please do reach out. You can contact us through the website itself or through our social platform presence. That's the other slide. I'll end with that. Barak, I'll go back to you if there are questions from the attendees or from yourself.
There are questions. I have also a question. Not all equities are same. So as you showed on the cap table, sometimes some shares has more abilities, such as golden shares, for example. Should you tell about the difference between common shares and preferred shares a little bit?
Absolutely. I mean, for investors, this is a very long topic. For founders, I mean, the way you should view it, usually founders will end up owning common shares. What I would advise founders to basically focus on is what we mentioned earlier: match your funding requirements with your business requirements, and match the people that you talk to and the investors that you bring with those 2 elements. So if you're able to master that, you should never be in a position where you do down rounds or you trigger anti-dilution, which is extremely bad to founders because it is most taxing to the founders. So the difference between common shares and preferred shares have anti-dilution. If you don't know what anti-dilution is, please do read about it. But in simple terms, it basically it guarantees the investors that if the company raises at a lower valuation than the one they paid for, they get an amount of shares for free that compensates for that dilution. So that is anti-dilution. So don't do that. Don't do an expensive round and then realize that you raised too much money at too high valuation, and then have to do a bridge round at a lower valuation, because that would trigger anti-dilution. And the other important aspect is liquidation preferences. Usually, angel investors, in the example I gave, they have liquidation preferences, but if they end up getting more shares than the Series A investor, they lose that preference, because if a company goes into liquidation, an angel investor might get more cash than a Series A investor, which is something a Series A investor would not allow. So these are 2 of the very important aspects of the difference between common and preferred: the anti-dilution and the liquidation preferences. There are others, like the preemption rights, like the reserve matters, like the protective provisions. It's a long list of things that differentiate the common from the preferred. And also bear in mind that you usually have more than one preferred class on the cap table. So you have the common, which is the very basic share as per the bylaws of the company, and then the preferred, might be preferred on, preemption, but not anti-dilution, might be preferred on both, plus protective provisions. It really is based on the shareholder agreement that you sign with each and every incoming investor.
And you have also shown that in the example that angel investors invest in the company, then the A round. And what happens to the angel investors agreement when the A round happens?
Excuse me, Barak, what happens to what?
When the A round investment happens, what happens to the angel investment round agreements? So if a startup get angel investment in the first seed round, and after they grow, scale up, they got the A or B round. So what happens to all the agreements?
Yeah, I mean, usually an A round would supersede an angel round. So all of the preferences that were availed to an angel round are basically canceled and transferred to the A round. I'm not saying this happens every single time, but usually it's a result of a conversation that happens between the founders, the angel investors, and the Series A investors. But usually, because these companies, and as I am certain all of you are aware, they basically live hand to mouth. So these companies need cash, and the Series A investors, the ones who come in with, writing big checks, they have the ability to negotiate better terms for themselves and deprive, others from them. So this is usually what happens. But I mean, in the example that I gave, if that angel investor had awarded their investment to the company through a convertible, that convertible would convert into preferred seed shares that have some preference over the common ones, but not as much protection as the Series A. So they're slightly wedged in between the founders and the Series A investors in terms of preference.
And you also mentioned about the employee stock ownership and also options.
Yes.
Employee stock ownership plan. And you also mentioned that it should be between 18 months and 30 months. I'm not, if I didn't misunderstand. And does it cost employee also something that to have these equities, or are they options? What kinds of different programs have you already experienced in employee stock ownership plans?
I mean, the most common one is that the stock options are priced at the same price that the founders paid. So in the example that I gave, if Burak and Mehmet had paid $1 per share, then for an employee to get that, they would also need to pay $1 per share. Now, do they actually pay it or not? That's a separate conversation. It might be, instead of a cash bonus, the company might pay it on their behalf, but there is a value assigned to that stock option. It's not at zero value. There is a value, and in certain cases, you do actually end up paying it. Now, why do I say it has to be, typically a fast, not a fast, but a relatively reasonable vesting schedule? Is in certain cases where employees are exposed to capital gains tax, if those stock options are awarded at a lower price, and then the company had raised at a higher valuation, those employees might be exposed to a capital gains tax because of the value that was created to them because of that employee stock option plan. So if you buy shares at $1 and the last investor came in at $2,000, then yes, you would have to pay tax on that. So it's preferred that you get your shares before they arrive at that very high value, because the tax might wipe out a good part of what you had to pay. I'm not saying it always has to be, a year and a half to 2 years. It can be more, but preferably in a year and a half or 2 years, the company wouldn't have built an enormous amount of value when that employee stock option plan is awarded. Obviously, that doesn't apply for later stage employees. And that's why you have a pool of options. The ones who come in early, who carry the higher risk, are awarded differently to the ones who come in later on when the company is de-risked. So it's basically giving preference to the ones who come in earlier.
So we have questions. Also, Mehmet has a question. How do you think the best way to evaluate pre-seed companies valuation question, or companies that are just started their life systems, I mean, probably initial stage. So it is not directly connected to the cap tables, but I mean, this is your expertise. Probably guess
Sure.
it.
Yeah, I mean, again, it's a function of how scalable is this business? Is it VC investable? If you spread it out into the future, let's say 5 or 10 years, do you expect this becoming a unicorn? All of these types of questions. What is the exit value of this business after a certain amount of years? If you have an understanding of what this company can be worth in the future, that should be your starting point in the valuation. You work your way backgrounds. All of this is hypothetical, it is theoretical, it is not based on cash flows, it is not based on market or business realities, it is based on the belief of the founder and the incoming investors of what the future value of the business can become. You can't apply DCF to a startup. In most cases, you cannot look at comparables, and in most cases, you cannot look at multiples. Now, people get creative and they use comparables and they use multiples. I would say for a very early stage initial funding round, that doesn't make much sense. And at the same time, my advice is, if this is your first batch of investors coming in, avoid doing it as a priced round, avoid doing it as an equity round, use convertible debt. It makes much more sense both for you as a founder and for the incoming investor. It really is a very effective tool to, I don't want to say avoid or delay, but it's an effective tool to put aside the valuation conversation until you have something tangible, until you've built a product, until it's gone into the market. Then an institutional investor would come in and they would have slightly better visibility on what that future value is. They'll give you a price round, and if your convertible note terms were well thought, both you and the fund and the angel investor would be quite happy.
And also another connected question is how to get the cap table done if you're in an ideation stage. I mean, it is probably, you mentioned that about in your slides, but should you also explain more?
Yeah, I mean, the venture backable deals are usually exposed to a dilution of anything between 10 to 25% on each funding round. Okay, now I would advise you that you keep it closer to the 10% in the very early stages, and you gradually build up to the 25%. So if you're raising an angel or a seed round, even if it's not a priced round, okay, you wouldn't want to be awarding, assuming that a conversion does take place, more than 10% to all of your angel investors, not one of them, all of them. Okay, and that amount of money should be adequate enough to carry you through to your next major milestone for the business, which is usually 12 to 18 months, depending on the nature of the market, the nature of the business and the market that you're operating in. But usually you would want to start at, let's say, I need to turn off the light and put on the battery. Sorry about that.
No worries. So we have several questions now.
So as I was saying, you basically need to make sure that you maintain as a founder, a meaningful ownership of the business and not award more than 10% at the early stages, and then ramp up slightly as you go through the funding rounds. Usually companies, I've seen companies raise their Series A, at 40%. That's fine if you have an extremely scalable business, okay, and something that will really has a good chance of, skyrocketing and becoming a unicorn in the future. Like I said, it's there isn't one template or one formula that applies to all businesses. It really is dependent on the business and the context of the funding round itself.
Ismot have two questions. Is there any explanation or a rule for a good co-founder? So he's asking how to find a good co-founder, and also he's asking how to calculate the valuation, and also how to present their details of co-founder equity shareholdership? I mean, which means how they can share the equities.
Okay, so I mean, the first question, what makes a good co-founder? I mean, companies, startups, they're living beings. They're not just Excel sheets and code. These are very personal relationships between the people and the teams behind them. So in my opinion, I mean, the three factors that make a good co-founder are integrity, honesty, the ability to initiate initiative on their own, and skill set. So if you have those elements in a co-founder on a personal level, I think that makes a good co-founder. Ideally, it'll be someone who you've worked with from before, someone who you've tested in a work environment, not someone that you've just got to know, or someone that you've only heard of through other people. It is someone that you preferably know quite well on a personal level before taking them on as co-founders. They have to be honest, hardworking people with integrity and initiative, and they have the skill set to deliver the value that you expect them to. You wouldn't hire a chief technical officer that hasn't written a line of code in their lives. You wouldn't hire a CMO that does not understand marketing, so on and so forth. So it really is, again, dependent on the type of the business. But I would say as much as we as investors like product market fit, we also like product team fit. So the product that you're building has to match, or the team that is building a product has to match the product that you're building. The second question was on how do you value a startup? I go back to what I said earlier. If you are a very early idea stage startup, reverse engineer that number based on your financing needs. So as an example, you now have an idea, okay? You want to build an MVP. Building that MVP will take you 12 months. You need $500,000 to build that MVP. Once that MVP is built, you believe that in the following 12 months, you'll be able to create $1 million in revenue. Companies in your space are trading, as an example, at 10x their revenue, which means that by the end of the second year, when you've sold $1 million of that MVP, you should be worth $10 million. So that's when you raise your Series A, or let's say your seed round. So how much should you give away to your idea stage investor and for that $500,000? In my opinion, no more than 10%. So ideally, you should value your company at around $500,000. Now, if your company needs $300,000, okay, not $500,000, then yes, your company is worth $3 million. The same rationale applies. I mean, it really isn't different. Don't get bogged down on pre-money valuations. Be more interested on what the financing amount will allow you to achieve. The real value happens much later. It really is a long haul, and it's not something that is determined or fixed on that initial funding round. There was a last question on equity. Barak, maybe remind me, what was the question?
Split the shares between co-founders.
I mean, the easy way is if you're putting money into the business, that should be factored in. So people putting more money into the business should get more shares. But usually, I mean, if no money is being put in, if it's your basic effort into it, I think that should be reflected on the cap table. So if you have, let's say, two co-founders or three co-founders, one of them is the CEO, one of them is basically the master of ceremony, the one who's managing the business. I believe in all cases that individual should be compensated differently than the other co-founders, and that's not based on him having, more intellect or more value. It's basically the importance of him in the survival of the business, both for the business itself and for the other shareholders that will come into the future. So that's really one way of looking at it. You can compensate that when you devise an employee stock option plan. if the CEO gets more shares when dividing the initial capital of the company, you might reward them less in an employee stock option plan and reward the others more. So there can be a balancing effect on the equity using tools like the employee stock option plan.
And we have a question from Gurmesh. He has a current station question. Do you think that the news of 90% successful COVID-19 vaccine means there may be an appetite to invest travel and event tech startups? I run one. He has also a travel and tech company and event company. So he asked questions. That's the reason. And what's your opinion about it?
I mean, I think the jury is still out on that. I mean, my opinion is you have multiple scenarios. Some people will tell you that this is the new normal, even if there is a vaccine. Certain industries are dead. You'll never be able to revive them. I don't believe that's entirely true. I think we will have a flavor of the new normal. So obviously, what we're doing right now has shown us that you can have an event. It's very different in nature than the one we did last year at the Volkswagen Arena. It still is an event nonetheless. It's not dead. It will come back. Probably when it does come back in physical form, it will have a much more virtual aspect to it than previous. So yes, I think the news about the vaccine is definitely a good thing by all measures. It will have a positive impact on the events industry, the travel industry, and all of the MICE-related activities. So all of that, should benefit from that. Will it come back in the same manner that it operated prior to COVID? I really don't think it will, but that's not entirely a bad thing. I mean, this opens up the field for people to innovate and come up with new ideas. It's actually a good opportunity to be coming into this industry than being an incumbent in it, because you really have nothing to lose and you have the flexibility to innovate and come up with some really disruptive solutions.
So Faisal, thank you very much. It was very valuable, an hour-long conversation and great presentation. Much appreciated. I think all the founders today, and Ozan is also online. And Ozan, how are you? Do you have something to say? Because we are nearly summing up.
Faisal, I mean, on top of what Faisal just gave as a cap table presentation, we should be doing this more frequently to the teams I'm mentoring. They go blank on when I talk to them about cap tables, like preferred shares, liquidation preferences. They're just really difficult. So one thing that maybe we can recommend is, if you guys are serious about fundraising, if you think still you are venture backable after what Faisal just gave you as an eyesight, and if you have clean cap tables, you have to check out the Venture Deals book, if you can, the 4th edition, and join the Venture Deals online course, because then you can have actual more time spending on the details of fundraising, and not just the fundraising early stage one, but what happens on an exit, what happens on a down road, what happens on with different scenarios. This is one reason we keep telling founders that fundraising is a full-time job almost. So if you are a two co-founder team, and if you're telling me, oh, one of us runs sales, the other runs product, and the sales guy is going to go and do fundraising, and on the side, he's going to still do sales, I would say you're delusional. If you have two people, one the CTO, one the sales guy, it is really difficult for somebody just to sell and then also to fundraise. It is really difficult to create a competitive bidding process, having multiple VCs, finding multiple VCs, getting them into a certain place, having their interest, getting term sheets, negotiating those term sheets. That's a 10 to 16 week process at good cases. if you really are not educated enough, you cannot start fundraising just because one VC or one angel told you they are interested. You should not forget this is a process. You cannot run after every VC, every angel that says, oh, you're interesting, we want to invest with you. You have to create competition to have good terms, to have better terms, to have a fair representation of everything else. Otherwise, you lose. Here's a photo bomb, by the way. Come. So I'm putting this backdrop of Seinfeld because my daughter just likes to photobomb all the things I'm having, which is great. I love being a full-time dad so far. So, as we were saying, if it's really difficult when you have one investor that wants to invest in you, you just tell them, thank you so much for your interest. We will start our fundraising process in 2 months because we are not ready to align multiple investors at the moment. We will make sure we prioritize you, but we can't just decide yes or no. And if the investor pushes you to decide really quickly, then it's the wrong investor, to be very honest. Unless you're really stuck and short on cash, don't work with investors that push you with timetables. But also, you have to be fair to the investors as well. They don't have all the time in the world to decide. And once they do the due diligence and give you a term sheet, you have to pull the trigger. You can't tell them, wait for 2 months. This is a really important process. I am really happy for you that Faisal was here to guide you towards this very, very freaking intricate process. So it's pleasure to have friends like him. And you as startups, you're much more better now compared to what you were a couple of hours ago. And that's because Brock was able to get all this run and Faisal gave you a great presentation. With all the flowers behind him, it really looks nice.
This is also my daughter's room, but this is the actual room.
We're getting used to living with our friends and family at the same house.
Absolutely. Ozan, thank you very much for the kind words. You really are too kind. I appreciate that. And Brock, thank you for having me. It was a real joy. Thanks.
Faisal, thank you very much. Ozan, thank you very much for attending at the end. And have a great night. Stay safe and healthy.